In this section of the course, we're going to be talking about support and resistance. So if you have been trading at all or even have a very basic understanding of technical analysis, you've probably heard the term support and resistance before, and that's because they are one of the most fundamental aspects of technical analysis that we have. And in this section, we're going to talk about how they actually work. We're going to introduce the concepts of support and resistance. We're going to look at supply and demand and how they create support and resistance levels, how these price levels are established in the order book, and we're going to show you some basic trading strategies that you can use to benefit from being able to identify support and resistance. So I like analogies, and we're going to start off by looking at a couple here. So the first one on the left, we have this nice road, big concrete barrier, and this barrier is our line of resistance. No matter how hard we try, unless you're going to flip right over it, this is going to be a barrier that you cannot physically cross on the road. You have full access to drive on either side of the lane that you're in. You can move back and forth, maybe even go to the next lane. If there's a barrier on the other side, you've got yourself a confined range in which you can drive your car. We're looking over here at the right, a nice picture of someone bumper bowling. If you haven't bumper bowled before, basically it's a little barrier that stops your ball from going in the gutter. You can roll that ball. You have a vague idea of which direction it's going to go. You don't know what pins you're going to go hit, but you can set a target, you can throw your ball, and you know that you've got an area of support and resistance, those two barriers, to act as a physical wall, keeping your ball contained. Now use that idea. Imagine a trend that we talked about before with the upper and lower trend line. Your ball is the price, and you know that you're going to be contained inside these two barriers. You can plan accordingly and try to make a good target, either a price point or a pin, knowing you can rely on those two areas of support and resistance. That's the key here, and that's how support and resistance can work. One more analogy for you, a bouncing ball. Now, if you have seen a descending triangle before, that is basically what we're looking at. We see a nice ball dropping from its height, an initial bounce, a lower high on that bounce, a lower high on that bounce, and each subsequent bounce gets lower and lower and lower. But it doesn't matter that it keeps getting lower because we are on a table. We know that we can rely on the support of this table forever. It is there, it is solid, it has acted as support many, many, many times, and the only time that we need to be worried about our ball falling below the table is if we actually run out of space and our support falls away. In this case, the ball, or in the literal example, the price, is going to drop further. The price and the support are intertwined, and you need that support there in order to make successful trades. In this case, each subsequent bounce represents a possible trade. So you can see how support levels can be very, very key. Identifying them, being able to know that you can rely on them, and also recognizing when those support levels are gone is absolutely critical for planning good trades with technical analysis. In this section, we're going to talk a little bit about supply and demand and how that supply and demand in the market influences both price levels and eventually support and resistance levels. So if you've studied any amount of economics, even in grade school, you know that supply and demand is what drives the overall economy. What people are willing to pay and what people are willing to sell things for creates the price point of pretty much every commodity, from milk to oranges and even to, in our case, tickers and prices of stocks. So what we need to accept is that the market is in a perpetual balance. It is always at a perfect balance between what people are willing to pay and what people are willing to sell for at any given moment. If you look at a price of a stock, whatever that price is in the very moment is the absolute truth, and that's the only thing that matters. Always, however, you have both buyers and sellers on one side, and they are chasing a theoretical price. Buyers might believe that the stock is worth much more than the current price. Therefore, the demand is going to be there, pushing the price up, perhaps meeting their expectations, but eventually sellers are going to believe that that price is overvalued and the price of the stock is actually less than it is currently. Therefore, they are going to sell and try and get a profit before the price goes back down. So both buyers and sellers are chasing the theoretical price that they have. However, the market's true price, whatever the price is in the moment, is the actual true price that we will use to create our areas of support and resistance, because we will come back to these prices. We will see them again and again and again, and I'll show you what I mean in a minute. But these repetitive experiences of particular price levels create support and resistance lines. All right, let's talk a little bit more about supply and demand, and let's go over the basics of the order book and talk about bid versus ask and how that creates supply and demand and our price levels and eventually our support and resistance lines. So the stock market in general is like an auction. You've got two groups of people. On one side, you have those who are willing to buy and are interested in buying something. They are bidding on a stock. And you've got a group of people who are looking to unload or sell what they already own. And they have a price that they will ask someone to pay. So you have bidders, you have sellers. Bidders are, of course, the bid, and the sellers have an asking price, so they are called the ask. Now, you can walk into an auction and you have several people who are willing to pay $3 for a stock. One person might be able to afford $3.50. And unless they can find someone on the ask side who is willing to sell at $3.50, they are not going to buy anything and there will be no transactions taking place. So you can actually flesh out an order book with thousands of orders on either side, but until you have two people agreeing on a price, either this gentleman here decides he's willing to up his price to $3.75 and buy what this man has, or you're going to have this man selling at $3.75 deciding he doesn't want to wait anymore. He'll give it to this guy for $3.50. That creates a trade, and that creates a last price, which influences the price of our ticker. So, to reiterate, two large groups of people, no price happens and no transaction happens until one of these two people crosses the line and decides they're either going to buy at the ask or this guy will sell to the bid. A little bit confusing perhaps, but let's get into a little bit more detail and talk about price action and trading. So while these guys and these guys can exist in the order book during live trading, people who are inside this tornado are the ones who are actually doing the volume and the transactions back and forth. These order books can sit there all day and never be touched, but you can have people coming in willing to buy $3.75, 75 cents over and over and over again until all of these $3.75 shares are gone, in which case the price is now $4. And we see the tornado starting to attack the $4 price. That's how prices move up. For prices to move down, we'll need to see this tornado selling to $3.05 until eventually he is gone and this nice lady still willing to buy for $3 creates the new price of $3 per share. So you have two large groups, a lot of crazy volatility and price action that is happening inside this tornado, and this tornado is representative of what is happening in the general market. This is the mess of traders that create that volume, that create all of those price changes for us. And these people on either side are those who create our areas of support and resistance. So let's go into a little bit more detail, and we're going to take this concept of the two groups and apply it directly to a chart. So we've established that we have our two groups. We have a group of people buying, we have a group of people selling, and in the middle we have a tornado of volatility and trading, people both selling at $9.33 and buying at $9.35, and that creates this volatility where the price goes back and forth between these two prices. 933, 935, 933, 935, till eventually one of these breaks down. Now, what we've got in this particular example is a big area of support. We've got a lot of people who are willing to pay $9.33, but we've got an even bigger group who are demanding that they want at least $9.35 for their shares. Now, there's no one at $9.34. Perhaps once in a while in this tornado, a trader will pop in and someone might scoop that up. But for the most part, we've got this big area of support and a big area of resistance, and no one is budging. So what does this look like when it actually shows up on the chart? And it's a little bit like this. So down here, we've got our area of support. Up here, we have this area of resistance, and we can see that even though we are trading quite a bit inside this range, we're not able to get below our support. We're not able to get above our resistance. And eventually, something changes. We push the price down. That is weakened, that support is no longer there, and then the price starts to fall. So going back to our two crowds, $9.33, $9.35, if we visualize this on our chart, we can see how this crowd of $9.35 manages to keep the price down. Because there are so many of them who are only willing to sell at $9.35 and no one willing to pay that much, the price can never move higher than $9.35. Inversely, we have a group of people who are willing to buy everything that they can at $9.33. So every time someone sells into $9.33, it doesn't move at all. Until what happens? That entire group who are willing to buy at $9.33 gets everything that they need. If we go back, we see that that group is much smaller than our $9.35 group. So eventually, the $9.33 support wall gets removed, the order book opens up, and we still have this big group of people up here who still need to sell. Maybe they start selling at a lower price in a panic because they need to get rid of those shares, and they drive the price down. So that is sort of how supply and demand, and it's a very basic introduction, but that's how supply and demand creates these price levels for us. We have two different groups who want two different things, who are unwilling to change their prices. The ask does not want to make any less than $9.35, and the bidders don't want to pay that much. So you get this range-bound trading where individual traders can come in and set the individual price point until one of those big groups makes a change. The price will not move. In this case, again, we lost our support. That group walked away, and all of these guys up at $9.35 start to panic a little bit, and they might lower their price to $9.30. It's trying to get ahead of each other and drive the price down, in this case, all the way to $9. So support levels are established when you have a group of buyers who are willing to pay a certain price, and their interest in the commodity at that price exceeds the selling pressure that they're receiving. They can sit there at $9.33 all day and receive every little bid that gets dumped into them. The price does not move below $9.33 because the aggression of the buyers is the same or greater than the aggression of the sellers. Resistance on the opposite side is established when buying interest is not as strong as selling pressure. The buyers bring the price up. We hit $9.35. We have a lot of people who want to sell at that price. The buyers can't push the price higher because there's not enough momentum and not enough volume to buy up all of those shares at $9.35. Eventually they get tired and the price falls back down. In this case, the aggression on the sellers is equal to or greater than the aggression of the buyers. So you get these areas of support and resistance where the price hits a threshold, $9.35, then falls back down to $9.33. We run into another group. It goes back up to $9.35, and you bounce back and forth between these two sideways lines of support and resistance. This is how every sideways channel or trend line gets created. It's this battle between supply and demand, between bid and ask, and all of the fun tornado volatility that happens inside that action. It all comes down to two groups of people, two different price points, and who gives up first.